First of all, how to avoid the two largest mistakes made by property investors. Irrespective of where you are in Australia, this is absolutely critical. What do I mean by that, and how do I know that they're the two largest mistakes? Well, let me talk you through that. They relate to, first of all, time and money. Now, please forgive me for being very simplistic with that. You might be thinking, of course they do. If it's a mistake and it's in real estate, it does relate to time and money. But what exactly am I talking about? What aspect of time and money are we actually referring to? Let's have a look at what I mean. In order to explain that, let's have a look at this graph on a typical property cycle. Now, Australia is a relatively young country in terms of our property records. We really only have 200 years of recorded data to go on. If we go back through history and we look at 200 years of recorded data, we come to some pretty clear conclusions. Number one, averaged out over 200 years, property markets have generally doubled every 7 to 10 years. Now, some people might argue history doesn't necessarily repeat, but 200 years have been quite conclusive where it actually has. And from that perspective, we can potentially draw some conclusions into the future, although there are no guarantees. But let's have a look at what history has taught us. If we dissect a typical property market into components, we look at a 10-year period averaged out. The first 2 years of ownership, absolutely critical to look at some of the things that could go wrong. Let's be really negative about property for a second. If you were to buy a $400,000 property, unfortunately, if you add stamp duty, bank fees, solicitors costs to that $400,000, invariably you might be paying $420,000 for a $400,000 property. You might be $20,000 behind the eight ball before you even start. Let's think about when you sell a property, what happens? You have real estate agent fees to pay, you have advertising costs, that might cost you $15,000. So being really negative for a second, a $400,000 purchase, if we were to buy and then sell, we'd have to sell the property for $435,000 just to break even. Now that's not to make a profit, that's just to get our money back. So what happens if we did happen to sell it above the $435,000 mark? Then the government would come back and say, hang on a minute, you've sold an investment property, you've made a profit, we're going to charge you capital gains tax. So being a little bit negative, there's a few things we have to be aware of, and people just generally don't go out, buy a property, put a for sale sign on the front yard and hope that someone buys it and they make a massive amount of money in the short term. It's not a get rich quick strategy. We have to really understand some of the things that really determine making it viable. Now, three such things would be: number one, the finance. Would we go out and get a 5-year fixed rate loan if we were buying and selling a property within the 2-year trade zone? Give you one example. Client thought they were going to make a $12,000 profit. Unfortunately, sold within 2 years, had a 5-year fixed rate loan, didn't realise they had $32,000 in early termination costs. $12,000 profit, become a $20,000 loss. That's point number one. Okay, in relation to the second point, are people aware in terms of contract naming that when you sell a property, in the year you sell the property, the actual profit is actually considered income relevant to the person whose name is on the contract? And a lot of people make mistakes here. The highest income earner might be on the actual contract, not the lowest income earner. So therefore, we might be paying capital gains tax at a higher rate. Another mistake that's commonly made for traders is they're not aware of the 12-month time frame in order to get a 50% reduction on your capital gains tax bill. So for example, if you hold a property more than 12 months contract date to contract date, you'll get a 50% reduction on your capital gains tax bill. So one particular example where someone sold a property 3 days before that 12-month mark and ended up paying an extra $35,000 in capital gains tax. So just three little points within the parameters of that trade zone. And I'll make a few more relevant points as we progress this presentation. Let's move ourselves forward to the 7 to 10 year mark. Traditionally, 200 years of recorded data has taught us that property markets generally double every 7 to 10 years. Now, once again, please don't think I'm trying to say that's absolutely going to happen in the future. I don't have the authority to do so. But if it did, how would that play into our hands in terms of our strategies, and how would we look at property investment in terms of getting the most amount of advantage out of any decision to purchase? Now, just a point I'd just like to make is the period of time between year 2 and year 7. Now, we refer to this internally as the grey zone. The grey zone because at the end of the day, what we're led to believe based on our national research is that up to 50 to 60% of all investors will have sold the property between year 2 and year 7 of ownership. Let's think about that for a second. Here's a period of time between year 2 and year 7 where 50 to 60% of all investors will have sold They're investment property. Now, how logical is that? Because on one side of the equation, what we're taught over 200 years of recorded data is that properties generally double every 7 to 10 years. And yet on the other side of the equation, here we have in alarming numbers, 50 to 60% of us, based on our national research, actually not holding the property that long and actually selling before the market has a chance to actually get to that particular point in its growth cycle. Very, very strange why so many people would sell, but I can give you two really compelling reasons why that does occur, and that'll lead me to my first conclusion of this presentation in the largest mistakes made by property investors nationally. So in order to explain that in more detail, let's have a look at the next slide. Now, this really encompasses three definitive stages of any given property cycle. The first phase is the actual slump, the period in the actual property market where the market, unfortunately, is either flat or going backwards in price. Necessary evil, not the most enjoyable part for any property investor, but a necessity in a particular property cycle. The period where the market is actually flat or going backwards. Now, that leads into the next phase, which is the upturn. Ever so slightly, we'll start seeing recorded data coming through that property prices are actually increasing in value. There'll be more people turning up for open homes, more interest, there'll be supply and demand pressures at play, and invariably we'll start seeing recorded data coming through with evidence of property price increases. That refers to the upturn, which leads us into the most exciting phase in any particular property cycle, which is the boom. Now, the reason they call it a boom is for obvious reasons. It's where the most amount of money is made in the shortest period of time. But let's rationalise that. What does it actually mean? Well, if we go back through history, we draw a conclusion that generally about 60 to 70% of the actual growth in any typical property cycle happens in roughly 30% of the time. Let's think about that for a second, draw some conclusions from it. 60 to 70% of the growth in any given property cycle happens in generally about 30% of the time. If we were to say that was a 10-year period, just to make it easy to understand, 3 years out of every 10 really accounts for 60 to 70% of the growth, which is the exciting time in a property market. That's positive. Let's have a look at the negative, unfortunately. The other 7 years is really unexciting. If 3 out of every 10 years is exciting, 7 is quite boring. If we analyse that and understand it, then it allows us to start drawing conclusions on how we structure ourselves and what sort of properties to buy and when to sell. So let's have a look at that in a bit of detail, and let's make reference to my last slide. What invariably happens in order to make 50 to 60% of people sell within that grey zone year 2 to 7 is the fact that throughout that slump period we find that people will get disillusioned with property investment. They'll think, well, hang on a minute, my property's not working, it's not going up in value, it's been a period of time now, the market's been flat, this just isn't working. We start doubting ourselves. Did we buy the wrong property? Did we buy in the wrong market? Should we have bought the McDonald's franchise? Should we have gone out and done something else? And these are all good questions to ask yourself. But what it leads to, unfortunately, is the fact that people then sell their property. Now, the longer the slump goes, the more people sell their property. But unfortunately, common sense also dictates that the longer the slump, the closer we are to the next upturn and boom. That can't be disputed. It's a pretty easy thing to understand that the longer the slump, the closer you are to the next upturn and boom. But unfortunately, a lot of people won't actually get to that point because they've given up and they've sold the property. Absolutely amazing how we see that occurring all around the country. And invariably, when the market does go up, a lot of people will say, if I'd only known what property markets were going to do, or what my property was going to do, or that particular market I was in was going to do, I would not have sold the property. So it's really, really important to understand some of the dynamics at play here. Let's have a look at 2003 to 2007, for example. What happened was the Perth market doubled in value over a 4-year period. Absolutely fantastic growth. Great for the people that had properties prior to 2003 or throughout that period of time. Not so good for the people that bought in 2007, because in 2008 we saw a correction in the Perth median house price. Some people actually bought at the wrong time in the cycle and actually lost money. Some suburbs recorded negative median house prices of $85,000 over between 2007 and 2008. So as you can see, the timing of the cycle was critical. Perth doubled in 4 years, And yet not everyone benefited because some people jumped on the bandwagon at the wrong time in the actual cycle. So it's pretty important to understand how that works. Now, what is the largest mistake made by property investors? Well, in essence, it's really not understanding and utilising property cycles. Some people come back and say things like, what if a area has gone up by 16, then 19, then 23% in 3 consecutive reporting periods? It must be good. There's got to be something right with this area. It's absolutely brilliant. I can't find another area in Australia like it. 16, 19 and 23% jumps over 3 consecutive reporting periods. It's got to be fantastic. Well, hang on a minute. Would that not dictate that the market's already moved? Would the boom have already brought prices up? And why on earth would we now buy at that higher level? On the other side of the coin, someone might come back and say, a particular market has had stagnation in growth for 5 years. There's been zero growth. I've done my research and I can't see any evidence that property prices have moved in 5 years. Got to be something wrong with that area. Why on earth would someone buy there? Well, hang on a minute. If history's taught us that 7 out of every 10 years is quite boring in a particular property market and only 3 out of 10 is exciting, doesn't that lead us to a different conclusion? That if we've already had 5 years of stagnation within the parameters of a particular area, would we not be more excited that, hang on a minute, how close are we to the next upturn? So we've got to look at things from a different perspective sometimes. Now let's go back to my point, how to avoid the 2 largest mistakes made by property investors. We know what the largest mistake is. It's not understanding and utilising property cycles to your advantage. Share investors, what do? Constantly, they look at graphs, they look at charts, they look at data. As investors in real estate, we tend not to do that. And yet right in front of us on a piece of paper or computer screen could be absolute answers and absolute logic we need in order not to make the mistakes that are made on a constant basis. The longer a slump goes, the more people get disillusioned, the more people sell. And unfortunately, at the wrong time in a lot of cases. So how do we avoid that? Well, one of the techniques we really advocate is quite simple. It's actually getting a valuation on your property every year and actually working out in relation to the equilibrium price where your property fits. Now, an equilibrium price is not an exact science, but what we recommend you do is when you get a property, you simply get a valuation or you look at it from your purchase price. What we then have to do is we look over a 10-year period and we try to get a point into the future where we believe that property market may be. Now, it's not an exact science and it doesn't need to be. You don't need to be Nostradamus for this exercise to work. At the end of the day, based on logic, based on maybe research, based on history, we just need to draw a straight line between those 2 points, referred to as a line of best fit or an equilibrium price. Now, the whole point of this exercise is we now have a gauge in which to measure where our property is in relation to this equilibrium price. Now, what we do every year, we simply get a valuation on our property. What we find is if the market's been flat, then you'll see a gap appearing between your property price and the line of best fit. The larger the gap gets, the more we start understanding the fundamentals of an undervalued market. The more we might say, hang on a minute, why?